Well, many on Wall Street now forecast much stronger GDP this quarter and higher stock prices to match. They say the recession is over, but my next guest says, well, not so much. A very cautious Gary Shilling, as always, economist and president of Gary Shilling & Company, here with me in the studio again. And welcome back to our program, Gary.
Thanks.
Okay, so as people know, you've been cautious and bearish for quite some time, but people are looking for a rebound now, a pretty sharp rebound, even some say. Why do you say they're all wrong?
Well, it isn't that there couldn't be an up quarter in real GDP. We've had 11 recessions in the post-World War II period, and in 8 of those, there was at least 1 quarter of rise in real gross domestic product. That's the norm, and it's usually related to the gyrations of inventory liquidation, which is a big factor in a recession.
Which is what people are talking about this time around.
But that's not the key point. The key point is the consumer. The consumer is on a big saving tear. I mean, we saw this announced yesterday, this huge decline in consumer borrowing. I mean, you know, a 10.4% decline, unprecedented. People are basically saving. They're using it to repay debt. Consumer, 70% of the economy. And as long as the consumer is in this mode, hey, forget about any economic rebound that amounts to anything.
Right, and you say of the 6 factors that you put together to say that there's going to be slow economic growth in the next decade, savings is your number one. That's the number one driver then.
That's right, and why it's important, Betty, is it's such a reverse from what we've seen since the early 80s. Consumers started off then with a saving rate of 12%. They ran it down to almost 0. I think now it's going back to at least 10% over the next decade, a complete reversal. It isn't just that they're on a savings spree, it's a reversal of what happened in the last 25 years, because that's what drove the U.S. economy and the rest of the world, because U.S. consumers, when they're buying more of everything, including imports, our imports, the rest of the world's exports, and those are goods and services that the rest of the world had no other markets for except U.S. consumers.
And yet the markets are saying the exact opposite of what you're saying, Gary, because you've had the market on a bull run for the past 6 months. Commodities just jumped, or oil just jumped like $3 yesterday. You've got the dollar sinking to a year low right now. So are you saying that people that are in those trades are going to lose a heck of a lot of money?
Well, I think that if you look at these gyrations in the economy, largely driven by inventories cycles within a recession, markets often reflect that. And on top of that, recognize that really we have one big trade out there. If you look at what was happening last year, stocks were selling off. There was a rush for treasuries, a rush for the dollar safe haven, and commodities were declining because of a global recession. Then starting in March, they all reversed. It's one big trade. Stocks rallied. Who needs treasuries? Who needs a dollar? China's going to buy all the commodities in the world, and that's what we've seen recently. And so they all move together. I tell my people in our money management operation, I say, hey, we think we're diversifying, but it's all one big trade. So if you're looking at one, you're looking at all of them. Okay,
and you still recommend, what, buying into treasuries?
Well, yeah, I think so. Actually, treasuries have been rallying since June. Even though stocks have been strong, and that, I think, tells you something. It may be substantiating our forecast of continuing deflation, among other things. Maybe it's a forerunner of a decline in stocks as people realize that the economy isn't going to have a follow-through rebound. There are people that say that the bond markets are smarter than the stock market, but I'll leave that to other experts to decide.
Well, the bond markets are certainly very powerful these days. Okay, Gary, since I've got you in the studio, we're just a week away from the Lehman anniversary, the bankruptcy, as you know. Just tell me, Gary, in your view, you think things have changed for the better or for the worse since a year ago?
There is more caution there. We're seeing deleveraging certainly in the consumer. We're seeing deleveraging in the financial sector. You look at credit default swaps. They were $56 trillion notional amount a year ago. Now they're $28 trillion. They've basically been unwound. The off-balance sheet items are gone. But, of course, the rebound in stocks has taken a lot of the pressure off for financial reform.
Okay.
We're seeing, again, the big wage increases, the big speculation in Wall Street.
Okay, Gary, we're out of time, but always good to see you. Gary Shilling of Gary Shilling & Company.